case you're wondering, it is officially a buyer's market. So for all of you people that are sitting on your hands waiting for the right time to buy, I well and truly believe the time is now. Let's have a look at some of the data that's coming out of CoreLogic realestate.com. So first and foremost, this is from realestate.com. It talks about the auction clearance rates. For some of you that don't know what auction clearance rates are, basically when you put a property up for auction, what are the odds that it's going to sell? Now this is just talking about what the percentages have been. So for instance, in Victoria, if you put your property up for sale, 62% chance that it was going to sell. In New South Wales, 52, Queensland, 38. And now the other markets are not really auction markets. So these are the three main auction markets. But as an average, you're basically looking at about, a little over 50% auction clearance rates. So about a coin flip that the property is going to sell or not. That's telling us that the market is well and truly softening, that there are less buyers in the market and they're taking more time to buy or just not, basically getting out of the market. When the market was running hot, auction clearance rates were up at sort of the 80% percentage chance of selling, and that's how many were clearing. CoreLogic data is very similar, maybe a little bit more positive than realestate.com, but realestate.com, it looks like to me, is actually getting more, have got more properties in there. Nonetheless, between 50 and 60% as an auction clearance rate is telling us that, properties are not selling as fast as they used to. Now, I do want to jump into some of CoreLogic's data. Now, if you don't do this already, I download this monthly chart pack and you can actually watch the CoreLogic team unpack a lot of this data so you can get it straight from them. But I want to jump ahead and talk about some of the things that stood out to me. Let's minimize my face. One, the 3-month changes in price is really interesting to me. Here you can see that the quarterly change is basically on the downward trend. Across Australia, it's about 3.4% down. The combined capital cities, it's 3.8% down. Now, this is largely led by Sydney and Melbourne. Sydney has dropped the most. A lot of the heat has come out of the market. And I like looking at the quarterly data because it's an indication of where the market is to go. Now, this is basically telling me that we're going to see more than likely another negative quarter, and it may be more aggressive than the previous quarter. So I anticipate the sales in Sydney, or the sales data, is going to actually decrease even more. Melbourne, Brisbane, Adelaide, some of these other markets will also follow suit and see more aggressive declines in the next 3 to 6 months. I'll jump ahead here. This is another interesting thing that I like to look at. It's basically talking about the quarterly change in the stratified hedonic dwelling index. What that's basically doing is it's breaking up the properties rather than saying the total property market. They're breaking it up into the lower 25%, the middle 50%, and then the top 75%. That's the bottom part of the market, the middle part of the market, and then the top part of the market. The one thing that has been consistent across Australia, relatively consistent, is that the top part of the market, the top most expensive part of the market, has been most heavily impacted. This makes sense to me, especially because a lot of the reason why the market's slowing down is because of the cost of debt. Now, the more debt you have, the more expensive it is for you. So that's the frothy part of the market. The really expensive part has been hit the most. Now, the most sensitive, the most resilient part of the market has been affordability. So you can see here that the cheapest part of the market has been quite resistant to dropping, and in some parts of the market is in fact still growing. Adelaide's performing well, Perth is performing well, Darwin as well. So it makes sense. But as the debt gets more expensive, people are moving, or price dropping, they're coming out of the middle part and maybe buying something that's a little bit cheaper. If they're buying something, it's cheaper than what it was before. So there's a lot more resilience in the more affordable part of the market. And we're seeing that in the form of apartments. Apartments are more affordable than houses. And we're seeing the gap between houses and apartments creep. Apartments are starting to meet there. So something else that's been really interesting to me, let's skip past all of this, are sales and listings. Looking at the sales numbers, it tells you about how much volume is in the market, what buyers are doing. It says here, sales volumes are trending lower as buyer demand slows. So as debt is becoming more expensive, as the economic environment is a bit unsure, as inflation numbers are still quite high, there are less buyers in the market. And since there are less buyers, we're starting to see that prices are starting to drop. Now you can see here the 6-month moving average is coming down, and this is the 5-year average. But basically there are less and less buyers in the market, particularly in Sydney. Canberra slowing down quite a little bit. Now this is interesting as well, the median days on market. So this is how long a property is up for sale. And you can see that August in 2021, that was when the market was running still quite hot. The average days on market across Australia was 26 days. And in the combined capital cities, it was about 25 days. So put your property up for sale, within 25, 26 days, it was going to sell. Combined capital cities now is 31, and then across Australia it's 33. So now it's about a bit more than a month for you to sell your property. So it's taking longer to sell the average property out there. Talking about Sydney, it's pretty aggressive. 25 days when it was really hot, now it's 37 days. Some crazy markets. You can see here Hobart, it was 7 days to sell a property. That's why it was really frothy. The property market performed quite well. And then now it's 33. So it's a much more normal environment. And you can see here as a general trend, regional cities are, they're coming back with a vengeance and taking much, much longer to sell. The properties are taking much longer to sell. Okay, let's continue. Vendor discounting, you can see now vendors are discounting properties. That makes sense. It's starting to get on a bit of a decline. Here, listing volumes is really interesting. What I want you to pay attention to, here we're in 2022, we're at the end of September now. We're moving into a part of the market, they call it the spring selling season. And you can see here that between October and November, we're going to be selling a lot more properties are going to be listed coming onto the market. So as a investor or as a home buyer, think about this. You've got more properties coming onto the market between October, November, then December it comes off. So between October and December, lots more properties coming onto the market. They're taking longer to sell. There are less buyers in the market. So, more property, less buyers. As a person that wants to look at investing, it's basically the perfect time to be buying property. You're competing against less people and you've got more selection ahead of you. Now, just a little bit of insight. I'm out there now looking to buy my own home. Peter, my business partner, just bought a property. Tiffy, my other business partner, just bought a property. We're out there in the market looking to invest. And I can tell you, being at the cold face, talking to developers, builders, vendors, landowners, they are more willing to give you discounts. They are more willing to budge on prices. It's starting to remind me, it's not quite as crazy as what it was during the GFC, but I wish I could have bought more property back then, because this next 6 to 12 months is an excellent opportunity. But particularly now, this 3-month window, as there's more stock coming onto the market, it's an excellent time to be looking for discounts, excellent time to be buying property. So I'll continue on. There's some more data that I find pretty interesting. This is just going into more depth about the listing values. The rental market. Now, for all of you investors that are out there, the rental market is going crazy, as we said and as we anticipated it would. We expected that as interest rates increase, debt would become more expensive. And because debt was more expensive, there'd be less buyers in the market, and the buyers that were there could afford less. So we anticipated that the bottom part of the market would be resilient. It would still perform quite well. Top part of the market was going to contract. All of that has happened. And we also anticipated that with less people buying property, it's going to put more pressure on the rental system, and the rents were going to increase. And as you can see here, that nationally, rents have increased by about 10%. And now this is my next prediction, that rents are going to keep on increasing. And this is because over the next 12 months, the government is encouraging more migrants to come into the market. And they're spending about $40 million. You'll have to quote me on that. I'm not sure if that's exactly correct. But we've got about 900,000 migrants stuck in our system that want to get their permanent residency. And the government is saying they want to spend some money to get a lot of these migrants into our system, get them permanent residency. They want to encourage international students to stay in the country. All of this is a perfect storm for one, migrants that get the PR to start investing in Australia, but two, all of the people that can't currently afford to buy to then keep on renting, and new entrants into the country are going to be putting more pressure on the rental system. So as an investor, now is a good time to be buying. Rents are going to continue going up. And as you can see here, rental yields are starting to creep back up again. So the yield is the amount of rent that you receive proportionate to the rent that you spend. Now, that is about it. One last slide. Thank you for being with me this long. The other part that makes all of this a really good time to be investing is the number of residential dwellings approved for construction have dropped 17% in the month of July. The sharp drop was due to a 45% decline in the unit sector due to the lack of high-rise approvals. There is also a supply shortage, a supply crunch. There are less approvals because developers and builders are going out there and building less property. Homeowners are building less houses. So there's less apartments being approved, less houses and townhouses being approved. And this doesn't really impact you now. These numbers impact you in about 24 months from now, because approvals are a leading indicator, because once it's approved, it takes about 2 years for the buildings to be completed, between 1 and 2 years, depending if it's a house or a townhouse or an apartment project. So you've got supply shortage. You've got more property, supply shortage in the next 24 months, that property's not coming onto the market. There are, as far as current market, more listings happening in the next 3 months. There are buyers coming out of the market, so you've got less competition. I hope it's become abundantly clear that now is in fact a good time to be buying. And if you're not ready, get your finances organized, get your equity out of your own home organized. If you're looking to use that equity, buy an investment property. Look for markets where, the rents are going up. Some markets perform better than others, but this is my monthly breakdown on what's happening in the market. Thank you, CoreLogic, for all this excellent data, and happy investing to all of you out there.